after a good refreshment. We are moving towards the second technical session, that is issues and possible solutions in finalizing GSTR 9C, filing of audit report on the portal. So we have with us a dynamic personality, CA Chandrashekar B D. I request Managing Committee Member Suvarna to escort sir onto the dais. And welcome sir with a bouquet. A very warm welcome sir. Chandrashekar B D, BCom, FCA, LLB, DSA. He is a commerce graduate from Vijaya College, Bangalore. He has secured 40th rank in the CA Foundation exam conducted by the Institute of Chartered Accountants of India. He is currently a partner of Mr. Shekhar and Yatish, Chartered Accountants, Bangalore, and is in his 20th years of practice. He is a member of Artha, a forum on indirect taxes, Akshara, a forum of taxation and general development, member of Federation of Karnataka Chamber of Commerce. Other areas of interest are reading, listening to music, teaching, etc. Presented various papers at various forums for both industry and chartered accountants in the field of indirect taxes with GST, service tax, excise, VAT, FEMA, and has authorized articles in this field. He is one of the members of the GST faculty of ICI. A very warm welcome to you, sir, and I request you to take the session.
Friends, happy afternoon. Happy afternoon. Yeah, so we are all there. Anyway, before getting into the subject, we'll have one small brain teasers, one or two. Then we'll get into the subject. We want some change, right? Jana change keltare. Yeah. So lot of technical subjects from morning. So too much of serial numbers, 5A to 5O. So many numbers are there. We'll try to keep the numbers a little low now. We'll try to see what are the aspects we can just understand in a colloquial language. I know how many of us have seen the GSTR 9C form. So let us not get into too very technical points, okay? We'll just understand it in a subtle way. Once you get into office, we have your seniors to discuss, or you can write to us. We are always there. So to get back to you, you can always get back to us on these things. Wherever you have doubts, you can always call us whenever there is a doubt probably. So that can be, or you can write a mail to us. So we'll just get into one of the things. Now we'll play KBC. Okay? So question is 2 0 2 4 इनमें से कौन सा सही है? ये 0044 0024 2024 2044. So one C has come. C A B also can. Huh? A B C D. See, the thing is, I think all the answers are right. If we read each and every one, where you put the comma? Are we going to read do separately and zero separately, or is it going to become do zero? How are you going to read it? So it's going to matter a lot. I think when you keep that with each number, I think each one appears to be right. Correct? This is our evolution of education system. Earlier in 1970s, calculate the surface area of an object, they would just give it directly. And today in 2018, you can see what is the color of rectangle and what is the color you prefer. That is what we have moved to today. The system of education has become very simple. Our analysis of the minds are slowly deteriorating. That is what we should look at, because we are more hooked to mobiles, internet, we are looking at people. We don't see a person who is next to us. We don't speak to him. We want to speak to 400 people who are there on Facebook. So probably I think we need to look at the way our teachings are. I think we'll have to look at. There was a study recently which in the US that has been researched, and it has proved that if you do a squat, pulling ears and squatting is very good. They have done a research and they have proved that there is a huge development in the process within 3 months. Haven't we all, or haven't our ancestors done all this? Or in our houses earlier punishments were given. I think our senior sir will tell how their teachers would make them stand, or even we have been doing that. If we had made a mistake, then they would make us go to the last bench. Dandam Dashagunam. That was the methodology. Why they made it, or why they gave us this punishment? To make our brains faster or activate the brain. And today we want a scientific logic. That day why they did it, we are trying to understand and see if a scientific logic is there or not on each of these things. Body massage, 499 rupees. Who wants? So this is like our audit before we accept. See, you are all article staff, or most of them are students here. So if we as chartered accountants have to accept some assignment today, before accepting a GST on this particular work, whether it could be 9 or 9C, I think today it has become a humongous task. The task of the filing of this returns is becoming a humongous task because of the requirements of the law. And the law has evolved because over the period of the last 2 years, lot of changes have happened, and based on these changes, lot of things have taken place also. With a small backdrop, so you have to be careful when we are doing the audits. That is what, because we are dependent on you. See, I am also a chartered accountant. I have to depend on my articles. I have to depend on my audit assistants who are coming, who are doing the work for us. Because each and every work I can't do. If I have to do, I can't take more work. So I have to maintain my office. I have to take work. So we have to see how the work is going to get executed. Then now, one of the recent updates yesterday night, we have seen that there is a notification which has come for Annexure 4. Whoever are where there are cases of real estate cases, they have to file a form Annexure 4. Actually yesterday was the due date, and this due date has been extended to 20th 5. So this is one update I thought which has happened yesterday. So I thought let us share it. So whoever have not filed Annexure 4, now you have an option if you want to go by the old scheme. In real estate, you have 2 schemes. One is go by the old methodology, one is by the new methodology, which is 5% without input tax credit. The other one was the old rate for old projects only. If I have to go based on that, I have to file the form Annexure 4, and this has to be filed before the jurisdictional commissioner. So a hard copy only has to be filed. So this is one aspect I thought if any of your seniors you can update, so that can be, the time has been extended and it can be taken forward. So now today with this particular session, I'll just try to see what all I can cover with respect to more of a practical knowledge. So practical analysis, we'll try to see what we can cover. And you can feel free, so that you can tell if something is already covered, because the first half an hour I was not there in Madhur's session. So you can just tell me if something is covered, I will not repeat it. So that let us utilize the time, whatever time we have, in a more effective manner. So the first one is with respect to the need of audit. So need of audit is not only for the assessee or Basically the audit is for the government. That is what we look at. And government has fixed the responsibility on the assessee now. So you have to get, because the government cannot or the department cannot do the audit of all the assessees. So this has been, now they have made it into a streamlined fashion. First you will have to file a annual report, annual return, then you will have to get the audit if there is a X amount of turnover which has to be done. What is the benefit for the department? The taxpayer has complied, has done compliance. The second one is timely recovery of the tax amount due. Then flow of credit from the taxpayer to the tax receiver. So there is a proper movement. So if I have sold some goods or service, then I should have done a proper filing so that the other person gets the credit. So that also is getting monitored now. Then from assessee's perspective, so see what happens if an error has taken place. For example, 17-18, we can assume now, 17-18 is the year, and today if we are doing the audit in 17-18, now we are doing after a span of 1.5 years. Now nearing about 1 year later we are doing the audit, we have another 50 days to go to file this particular report. So now only I can tell that there is a damage which has already occurred, because if I have not paid some taxes or if I have taken some input tax credit which is not supported by valid document, then I have to reverse the amount or pay that in the form of a taxation liability. So for that liability what happens? If I have to pay say a 1 lakh rupee tax which has got arrived based on that 17-18, how much is the amount I have to pay now if I have to pay? I have to pay with interest. Anyhow, you have already filed the return, so late fee may not be applicable. If the return is not filed, then late fee also will become applicable. So this is another issue which could come up. So we can, actually it is a benefit for us to the extent of from the assessee's point of view that later, see today only if you have to pay a tax for July 17 if you have to pay a tax now, it is already nearing 2 years. So what is the interest I have to bear? It is going to be about 24% or 18% depending upon whether it's an output tax or an input tax payable. So depending on that, I will have to pay the interest, and the interest has to be paid till today. So which is nearing about 2 years. Assume that we conclude the audit in the next month. So once we are seeing there's going to be so much of interest which has to be paid, so it will come up to 150% effectively now only. 150%. If a tax of 1 lakh is to be paid, 50%, nearing about 50%, 1.5 lakh. Assume it is done after another 3 years, it will become 2.5 lakhs. So just see, this is a compliance. This can reduce future damage to the assessees, and this is going to be helpful for the assessee's perspective. So that is why we need to give importance to each and every point what was discussed in the morning also. Okay, you need to look at each of the point, and again this is the only last point which can be taking place, and we have to report it. So we have to see that we mention it in our audit report, and we see that that has to be paid. And wherever audit cases are not there, then GSTR 9 is going to be the final one, and once that is concluded, then only after the departments call for a verification, or if there is going to be scrutiny, only in those cases we will have to make the payments per se. This is the last chance we will have, whether it is 9 or 9C. During this time, we have to see that we have done it a little more methodically on this particular process. I think audit, he was mentioning, he has already defined this particular thing. I will not go about in this point. I think 35.5 and 83, I think he has already discussed. So this also I will not look into. So here it talks about only one point I want to add here. 2 crores is the total value. It is the aggregate turnover. Aggregate turnover of the Pan India. Pan India has to be concluded. And for the audit purpose, what is the turnover value I need to consider? Whether it is to be considered from July 1st or should I consider from April 17 to March 18. This is another point. This is a litigative view. Few of us are of the view that it should be from 1st July only, because GST Act came only from 1st July. So how can they ask us to give a financial turnover of the previous entire year? See, the law only came into effect from 1st July. So how is it? But our institute guideline has prescribed to consider a conservative view, and they have told that from 1st April is the financial turnover we have to consider, and based on that you arrive at the aggregate value. So what is that we need to look at? So GSTR 9, I think this 44 2 also he has covered per se, I think, right? He has already covered it. Then aggregate turnover. Aggregate turnover is the total turnover minus only taxes. Which are the taxes they are giving? CGST, SGST, UTGST and IGST. Only these four are given as a deduction, and all others have to be considered. Assume that I am into both taxable as well as non-taxable turnover or exempted turnover. Then I have a 1 crore of taxable turnover, 1 crore, 1.5 crore of exempted turnover. Do I need to do the audit? It has to be done. So for this, we'll try to understand one case. I have a presence across India. So one of the branches is in Bangalore, so that is the registered office, and I have another one in Tamil Nadu which is not registered. I have one in Bangalore, one in Hosur. So this other one is not a registered turnover. Could it be possible that the other unit is also not registered itself? Can it be possible? Is it possible or not? It could be possible if the other branch which is dealing in only say agricultural produce or only exempted goods or only exempted services, then in that particular transaction I need not register that particular unit. That is one aspect. So this, when we are considering the aggregate turnover, we have to consider both for the purpose of levy.
By virtue of threshold limit, if the branch is not get registered in the other state, it has to be audited.
Correct.
If by exclusively if they are dealing in agricultural produce, that is exempted goods under GST, you can eliminate.
Yes. That if they are registered, then automatically they will get under 9C. If they are not registered, then in that particular case, I have few examples. I think I will come to that a little detailedly. So that will help us to understand. So what is the relevance of aggregate turnover? Okay, this is one of the aspects which has to be looked into. Next, to understand one, Tamil Nadu branch has a turnover of 100 lakhs. Okay. Next one is Karnataka branch has a turnover of 120 lakhs. One is registered 100 lakhs, the other one is unregistered 120 lakhs. So total 220. So if I consider only 100 lakhs, that is nothing but 1 crore. If I consider 1 crore, I will not be liable to 9C. So here in this case, are we liable or are we not liable? So here 9C is required. Okay. Next one, branch Tamil Nadu 80 lakhs is the registered thing, and Karnataka a turnover of 120 lakhs. So totally it is coming to 2 crores. So should we do? Should we not do? 2 crores. What is the definition telling?
Includes exemptions.
So whose aggregate turnover exceeds 2 crores. So 2 crore 1 rupee it is taxable, 2 crore it is not required. So exceeds is important. So it is equal to 2 crores, so it is not required to be done. Okay. Then next, both are unregistered branches. One is having 100 lakhs, other one 180 lakhs, one is having 120 lakhs. Totally it is 3 crores. So I would not have applied for a GST number itself if I have not registered basically. So in that case 9 or 9C will not at all get. Here 9C will not get applicable. It is not required. Next. Yes sir?
That is such kind of business are there.
There could be a completely into exempted business, then in that particular case they might not have at all have registered. But only thing we will have to see, is it correct? We'll have to examine that aspect, and as when you are also doing as a tax auditor under income tax, then probably we have to just examine whether what stand they have taken is right, not right, and then if it is completely exempted, 100%. See, if you are a trader in agricultural produce or in this particular transaction, then there is no requirement basically. But today, what is happening is because of the e-way bill issues, few of them don't want to get into that, they are registering. But once you are registered, then for you it will be applicable. So that is what is the point which has to be considered. Next, branch in Tamil Nadu turnover is 100 lakhs, branch in Karnataka 120 lakhs. Both are registered. We have to do it. Okay. Next, branch in Tamil Nadu turnover is 80 lakhs. Then branch in Karnataka turnover is 20 lakhs excluding stock transfer of 90 lakhs. So here what is the amount we need to consider for the purpose of calculation? Is stock transfer a sale? If a stock transfer is within the same state, then that is not treated as a taxable transaction. If there are two states involved, then that becomes a removal for the purpose of levy, and we have to discharge duty, because once it is moved from say Karnataka to Tamil Nadu, then that transaction becomes a taxable transaction, and in this case, whether you do or whether you don't do, both it will be within the limit of 2 crores, so it is not getting covered, but you have to examine that aspect. If the entire stock transfer was in only Karnataka, then my actual value of transaction would have been 80 plus 20, it would have been only 1 crore, but if I have this stock transfer of 90 lakhs which is coming from Karnataka to Tamil Nadu, then this 90 lakhs has to be added and totally it becomes 1.9 crores. Okay. So this has to be examined. So technically that has to be looked into. Next, branch in Tamil Nadu turnover of 180 lakhs unregistered. Branch in Karnataka turnover of 10 lakhs excluding stock transfer of 20 lakhs. So here also my answer for the earlier question will stand good, that if my stock transfer is going to be within Karnataka, I need not consider this particular turnover, but if this stock transfer is from Karnataka to Tamil Nadu or any other state, then I have to consider this value and the total is going to be taxable. So I need to consider that 20 lakhs which is going to be 2.1 crores. Clear? Okay. Next. See, what happens when we are doing a reconciliation? I have my balance sheet separately, figures are there, and I also have my forms, one figures is there. So what all I need to confirm for my reconciliation, what all I need to, these are all only a check points what we are going to look at. The first one is, I am going to check my audited financials with the forms filed. So that is one check we will have. The second check what we will be having is with respect to Form 26AS and the IT return filed. If for example there are service industry, then all supplies TDS would have happened. So as per my TDS, there could have been a X amount of turnover. Say assume we have a 2 crores turnover as per TDS or 26AS, but my financials is showing only a turnover of a lesser value, say 1.5 crores. So we have to identify why there was a difference, and we have to understand why that 50 lakhs difference was there. Probably they have deducted in the last year, but for me the payment came only in the current year, so I have not declared in my financials because I may be following cash basis of accounting, and here the other person is doing a accrual basis of accounting. So he has accounted for that. So do we have valid supporting to see on a later date whether should I have already got the audit or not? Have I got a reasonable basis? If I have a reasonable basis, then it is fine. If I don't have a reasonable basis, then better to consider my turnover under 26AS and get the books of accounts audited here. E-way bill summary report. So e-way bill summary report is you can download from the portal itself as to how many e-way bills have got generated, and you can compare that with the whatever outward supply or inward supply. We can identify where all the differences are and keep it ready. As morning also Murali Krishna sir told, see, it is better to have a reconciliation, because on a later date if the department calls for some information, we also already have it ready and the same can be provided to the department, so that the maintenance becomes very easy. Because now also when VAT assessments are being done, they are asking for e-way bill reconciliation, so it will be easy when we go for assessments. Then delivery challan plus fixed asset register. If there are transfers within the state, as I told you, that will not come under a taxable transaction itself. So it will be, say example, I am sending chairs and tables from Bangalore to, I am sending to Mysore. I have another branch in Mysore. So what happens? Will that be considered as a turnover? No. But I might have raised a e-way bill for that. If the value is more than 50,000, I would have raised a e-way bill. Even though it is an internal thing, I have to raise a e-way bill for my internal transfer. Own use, I can raise a e-way bill and put a DC for that particular transaction, and it can move. So in my fixed asset register, I would have made an entry from Bangalore to Mysore. I would have just done a stock transfer entry, because this is location specific. So whatever I record is going to be location specific. So this also has to be examined. Okay. Then next we'll get into where during the year I am a dealer. First 4 months I was under composition scheme, then I opted to go for regular scheme. Is it possible? Yes. So initially I might have opted for a composition scheme, then after a particular date I told I will get into regular scheme. So once I did that, so from July to say October, I was under composition scheme. From 1st of November, I was into regular scheme. So do I need to do 9C or what I am going to file? Because there is going to be composition dealer also, and also I will have regular also during the same financial year. So in this transactions, what are we supposed to file? No answers. Both the forms. I think that is a reasonably thing. So we have to do 9A, 9 and 9A, and 9C will be done accordingly. When I am considering the turnover, I have to consider all the 3 turnovers. If you are going for a conservative view, as I told, April to June also I will be adding the turnover, and I will be taking the other turnovers as well, and the total turnovers I will take it to for the purpose of turnover. But I will be including even these items like interest, forex gain or loss. See, foreign exchange gain or loss, it is not liable to GST, but I will be showing that as a P&L account item. That also will be considered as a part of my turnover, even though for GST purpose there will not be any liability, because I would have raised, when I raised for $1 lakh, I raised a bill on my customer. When I raised the bill, it was 69 rupees, but when I got the amount from the customer, that day it was 71 rupees. So I got 2000 rupees more. 2 lakh rupees more, because 2 rupees into $1 lakh is about 2 lakh rupees I got excess. That will not be a taxable transaction, because it's an export transaction. Once it's an export transaction, there is no levy on that particular transaction per se, but it will be an exempted transaction which will go and sit in that particular transaction per se. Then like that we have profit and loss account. You may have sale of fixed assets, or because to the earlier regime we might have got something and it is discarded per se. So those sort of items which are also to be included for the purpose of GST turnover. Non-GST credit notes. There are financial credit notes during the year, and because of which I got some credits. See, my purchase, whatever was there, the seller gave me a financial credit note. So because of which I got an additional, say 1 lakh. That 1 lakh which is sitting, so that also has to be considered for the purpose of this calculation of 2 lakhs per se. Okay. Then next we will get into April 17 to June 17. What is the turnover we need to consider? according to me, you need to take the books of accounts. What is the turnover as per books of accounts have to be considered for April to June. So these 3 months you will be getting a turnover, and that turnover has to be taken for the purpose of filing these particular forms. Because under each of the act, if you go under service tax or excise or VAT, each one gives a different value. So we will not be knowing which value to consider. We may get a little confused when we take different forms, because in each of the form these things could be represented in a different manner, and that is based on that particular law. Because here if it is considering, then we have to consider the books of accounts, and in the books of accounts what is my incomes I have considered, that has to be taken forward, and that becomes the turnover per se. And a little bit of an adjustments have to be done, because there could be sale of fixed assets. So if that is there, those have to be earmarked, and that has to get added during that particular financial year. And the invoices which were issued for the 3 months for which money is received post July 2017. So that also becomes a part of the previous turnover as well. Then next one, when we come into the forms, I think this all of are clear with this particular presentation, or you want me to just throw a light on one line?
Yes.
You want to? See, there are in a first, what will happen is we will have a annual return. Okay? In annual return, first we will have GSTR 9. So who are all liable to file annual return? Every assessee who is registered under GST has to file annual return, except there are few exclusions, which are input service distributor, CTP, casual taxable person, NRTP, TDS and TCS cases. These are the people who will not be filing the annual returns, because there are separate forms for that. If you are under compensation scheme, you will be filing 9A. Then if there is a TCS, then GSTR 9B has to be filed. Then when it comes to the audit, it is 2 lakhs and above, 2 crores and above turnover, we will have to file the 9C, which we have dealt in detail. So till now, most of us are clear as to what is applicable, what is not applicable. Okay? So this is the flow of events, and I think in the second half they will give you more details about 9 and issues regarding 9. You will have a detailed session or discussion on this particular aspect. Okay? And as of date, the 31st December was the year ending for most of these forms. But because of the new implementation, and we had software issues and glitches which were there, because of which only for 17-18 the due date has been pushed or extended to 30th/6/2019 for 17-18. For 18-19 it is going to be December 19 is going to be the due date for these forms. So what is the order of filing these forms? See, first always any form when we are filing, the first forms what we have to file is 3B and 1, that is the forms have to be filed compulsorily. Earlier we could have filed 9 and 9C, but they recently got an amendment to tell that unless and until 3B and 1 are filed, GSTR 9 cannot be filed. So the first order is every month I should have filed for July to March, July 17 to March 18, I should have filed all my returns per se, first condition. Second one, only if I have filed the forms, I will be able to file GSTR 9. Only if GSTR 9 is filed, GSTR 9C option will get open. Otherwise, GSTR 9C option will not at all open per se. Clear? Then, why we should do 9 or 9C? That I will indicate this by way of a point which there are sections. Section 44 prescribes for GSTR 9 along with reconciliation in form 9C has to be filed. If then section 47 provides for levy of late fee for furnishing returns under section 44, which is 100 rupees per day per act. So effectively it is 200 rupees per day, because the penalty can be one under the CGST, one under the SGST. So it is a 200 rupees per day penalty, and or 0.25% of the turnover. So 0.25% of turnover. So if the turnover is 2 crores, so it will be 0.5% here also, because 0.5% per act. So totally it is going to become 0.5%. So that could be the maximum penalty. So whichever is less will be the penalty which could be levied. I think we have already seen that even under the VAT Act these penalties were levied if VAT 240 was not being filed, and per day we had to pay. There also 5,000 rupees plus 50 rupees per day was the penalty which was there under VAT Act. Similarly here also they have got some penal provisions. So wherever there is a doubt, we should always say if the somewhere we are very close to the 2 crores, then it is always suggested to go in for a audit to avoid complications. So because to avoid these penalties per se, because department comes based on the returns which is filed and what all information the department has got. Based on that some reconciliations will be done, and one day they will tell you should have filed 9C because the total value is crossed 2 crores. Probably, I am just telling you. So that has to be again, so we have to go through each of the forms and take it forward. Then what are the books of accounts which needs to be maintained for taking our 9 and 9C? First one, availability of books. Any business, whether it is a manufacturing, trading, service, whatever you take, we need to have something called as a inward register and an outward register. So inward, generally we will know what is the goods which are coming in, what are the services which we are taking. So services it is a little difficult to track, but however we will have the invoices, and based on that we will see that the services are taken. Then we have for production, if you are a manufacturing, you will have a production register or a manufacturer of goods. If you are a works contractor, then what will be your inputs? What will be the inwards for a real estate company, a builder? Is real estate a supply of goods or supply of service? Service, that everyone are clear. So once we get into, basically it is construction related activity, then it becomes a service. The end is service, but most of the, we have inputs as well as input service, both will be there, so we have to track that. That is important, it is required now. And with the change in the recent amendments in the law, this not only details we have to maintain for the assessee, it has to be maintained project wise. So if I have 2 projects running parallelly, then I need to maintain it for both the project A and project B. Both the projects have to maintain this particular register. That is what the law has told. So it is always better, because if there is any input tax credit which has to be given and we have identified, because real estate there were a lot of amendments which were there recently, and because of that we will have to calculate what is the reversal of input tax credit. So there could be cement. I don't know cement is used for project A or project B. How will I know? So at least there they tell, based on reasonableness, you identify and you allocate for project A and project B that particular, based on the maybe percentage completion or number of square feet. Try to arrive and bring it into, for project A these are the amounts, for project B these are the amounts per se. Okay. So like this we have to maintain stock register, stock of goods. Whether it is a trading, manufacturing, we have to have a stock register basically per se. So only technically there are few cases where it is impossible to maintain. It could be a small, maybe a kirana merchant or a provision store. There it could be very difficult for them to maintain the stock registers per se. So there we are maintaining the major 10 items, and that is what the law told, that in GSTR 9 provide only HSN classifications for those 10 major items per se. So we will have to identify those 10 major items and take that particular transactions. Then standard input output norms. So this was there under the Central Excise and Customs law, where we had standard input output norms. See what happens here under the GST law, there is nothing called as abnormality as such. They are not brought out the concept of abnormality, or even the standard input output norms is as well not brought into the picture. So they have told, for example, I am a manufacturer of sofas. I buy resin. This resin can be used for the manufacture of sofas. The other person also buys. For one sofa, I use 1 bottle of resin. The other person uses 2 bottles of resin. Is there any standard? Because it depends on the quality the person works, and it can never, in a service industry, it becomes very difficult for me to maintain. So this particular aspect has to be, should not become a problem at a later point of time. But we need to be reasonable in whatever we are showing. So for one sofa, you can't show 100 bottles of resin which is being shown. So that cannot be, there should be some reasonableness in whatever decision we are taking. Then there could be stock adjustment entries which have to be looked into. We may write off few entries, stock written off, because it may be obsolete and I may write off that particular thing. So today I have old Pentium 1 system, P1 system I have got today, stock. I am into computer business, I have P1 stock. Will anybody buy that today? Even today the mobile phones are faster than the P1 system, correct? Okay, so this is what, so in those cases we may have to write off. Once write off is done, we will have to see what is the reason for write off, how are you going to pass these entries, provisions. Then advances. When advances are received, whether it is for goods or services, so what is the provision we have under GST law, a provision for advances. So if I am getting some advances on services, I am supposed to pay tax immediately. Okay, when I receive an advance, I have to pay the tax on that immediately and declare it in my GSTR 9. But goods, they told, I need not pay on these particular advances. So from 15th of November, this particular transaction we need not pay we need not look into. But till from 1st July till the 15th of November, we are supposed to look into that particular transaction for advances. Specifically, we have to see if there are some unregistered purchases, then we are supposed to make here we are talking about advances. So if I have received any advances, I should have paid that amount, and that amount I should have paid the taxes on that, else we will be liable for interest. So this should be captured now. So details of suppliers and customers, this is one which is important, which is required when the books of accounts are maintained as per the provisions. Then, but today we have certain challenges with respect to the ERP environment, because ERP is not yet still settled, because we are trying to make certain changes in the ERP, then immediately we see another change in the law which is happening, because of which again that is taking a back seat, because most of the calculations whatever we are doing, we are not able to take it in the softwares because of this. Say if a client is working under SAP environment, and today we saw that on 1st of April, on 29th the law gave notifications, and from 1st of April we are supposed to implement that notifications. So earlier we were following a different methodology, and now we have got accustomed to that particular thing, and from 1st of April immediately there is a change. So how is the software is going to get changed on a one-day basis? Is it possible? No. So these are ways we are finding it difficult, and capturing information for GST purpose also is becoming a challenge, and this is where we also have to become a little more sharp and little more fast enough to see that the softwares are in line with this particular books of accounts per se. And documentation with respect to 9.3 and 9.4. 9.3 is nothing but unregistered, or this is a reverse charge mechanism with respect to few of the categories where the service receiver is supposed to pay taxes. In 9.4 it is relating to unregistered dealer purchases which I am doing, whether it is respect to goods or services, where I need not pay taxes from 13/10/2017 onwards. That has been removed. So, but we need to maintain documentation for these information which is required per se. So what are the information which is required to be captured for 9C? This is one which is very important. So first we need to bifurcate the transaction into any input tax credit which is there. First we have to bifurcate it into input credit on capital goods, input credit for inputs, and input credit for input services. So these are three things we have to bifurcate first. Once we bifurcate this transaction, it becomes easier for us to identify what has to be reported in 9, because this is also important for 9. I think whoever will take, they will explain this again. So this is important, and here we also have to maintain this bifurcation which is required for SEZ supplies, then for reverse charge mechanism with respect to UID purchases, RCM procured from registered dealers, and input tax credit from other suppliers. We have to maintain this so that it will be easy for us to input it into our forms which are discussed earlier in the morning. Then next, these are the dates which are important. We will have to look at these dates. Okay. So first one, transactions, we will have to break it up into before 36/2019, that is one bucket of transactions. Then second bucket is from 1st July to 31st March 2018. In that we will have a breakup of 1717 to 131017 because of unregistered dealer purchases 94 we require. So that is what, so we have to capture that information also separately. Then advances received for goods. So for advances received for goods, it was liable from 1717, which I already discussed, up to 15/11/17. I should maintain the transactions, what has happened for this particular period separately. Then transactions, if there is any rate change, because if you take a restaurant business, there was a rate change between 17 and 18 during October. So we had a change in the rate, and because old rate was different and new rate is different, so certain details will be required. There could be many other businesses, so this classification has to be examined for each and every case, whatever we are handling. That becomes easy. Then we get into exempted, nil rated, non-GST supplies. So here these are transactions which have to be separately reported, and this is going to be net of debit and credit notes generally, because there is no separate column to declare for exempted transactions. If there is a credit note, I don't have a separate column under these forms to declare. So it's going to be a net of debit or credit notes if any. Then if we also require inward supplies from composition dealers. If I am procuring from composition dealers, then I have to maintain this particular transaction also. Then the next one is, if there are recorded in the books of accounts between 17-18, there are few transactions. What has happened? I have not declared my sales. Within March 2018, I have not declared a sale of 1 lakh. I identified when my tax audit took place and I declared it before September 18, and I rectified it in my subsequent return in September 18. I paid the taxes for this 1 lakh. So that is one category of transactions which have to be earmarked. And similarly, if they are not reported till date, there may be possibility that the transaction itself is still not reported in my GSTR 3B. Probably the assessee thought I will declare it as and when 9 comes into picture. So if he is able to pay, he is going to show that under the DRC 03, and he has to make the tax payment. If he is not, if he has filed his GSTR 9 also as it is, then it is the duty as a chartered auditor or as an auditor under 9C, I have to identify this particular aspect, and that has to be added into my liability, and I have to make them pay this particular tax. This is clear? You came to know step by step. These are the informations for every client we have to take. Key points for 9C finalization. See, there are, when we take up this particular finalization, here we have, first one is GST registration. Always we have to get into this GST registration. Here, whether it is a migrated case or a new case, we have to examine whether it is a migrated case or a new case. If it is a migrated case, certain documentation, certain flow should have happened, whether those things have happened. Because initially there were few cases where there was a problem in migration from the GST portal, and they got the registrations itself late. So it was delayed by a month, 2 months, sometimes 3 months. So it has happened up to. So that was the reason, like in few of the cases they even gave a waiver fee. So there was a waiver of late fee also. So that was also there. Then whether all places are registered. Today I have one branch in Bangalore, I have a branch in Mysore, then I have a branch in Chennai. There are 3 places I have registrations. Have all the places got registered? If Mysore, Bangalore and Mysore, I have 2 units, only Bangalore I have registered, I have not registered Mysore. I have not shown that as an additional place. Even though it is more of a procedural lapse, but I should have registered this because I am storing GST paid goods in Mysore, so I should have registered. So if that registrations have not been properly done, because that we will not come to know unless and until we take the information from the client. See, this probably one information can be got even from the income tax audit report, because there also tax audit report, they have already found this particular information. So whenever we are doing a 9C, we also have to take the annual accounts of the business. So whatever has been signed, a statutory audit report along with the financials, if you take, then you will come to know what all has to be looked into. You need to look into the notes on accounts, you need to look into the tax audit report, what are the additional places they have declared in the tax audit report. You will come to know in those things whether they are in line with this or not. So when we take the certificates and compare it, we will come to know where these issues are there. Next one, is there any unregistered place of business? Identify that, which I told. Then GSTIN displayed on the name board at all places. So this has to be done physically. So this is only to avoid penalty. See, from our side, as Madhu was telling in the last, so we have to look at whether all the provisions of GST law are satisfied or not. We'll have to look into, and this is one of the important aspects where we have to see whether the notice board or name board, whether it is displayed on the entity or not. That is one place which we have to look at. It has to be displayed not only at the head office, it has to be displayed in all the places wherever I have a additional place of business. So if I have in, say in Karnataka I have 10 places of business, then all the 10 places the name board has to be affixed. So we can have a checklist to find out whether these things are done, not done. When we are going for bigger audits, it is always suggested that we have a control of each of these things, which is very important. Then check whether any amendment is required. See what happens during 17-18, one of the branch is closed. In Mysore, say Bangalore, Mysore was closed. But in the even today that GST in the GST portal that is being shown, but they have not cancelled the registration. So probably, or there is a change in address which has not been intimated to the GST department. So here, if we look into the tax audit report, it shows as Jayanagar. If you show in the GST portal, it will show Vasantnagar. So these are issues which are going to crop up at a later point of time. It is suggested that these are brought to the claims notice and immediately these are rectified. Then document verification, tax invoice cum bill of sale, or tax invoice, bill of supply, and invoice cum bill of supply. So can I issue a tax invoice? Who are supposed to issue tax invoice? Any registered person who is there under the regular scheme. A person who is there under the composition scheme, he has to issue a bill of supply. Or if a person is dealing with exempted product or a non-GST product, then he is also going to issue a bill of supply. What happens if the same person is doing both? I am a businessman, I have both. I sell rice also, I sell chocolates also. Rice is exempted, chocolates is taxable. So then in this particular case, I will issue a invoice cum bill of supply. When I have both taxable as well as non-taxable transaction or an exempted commodity, then I will be issuing a invoice cum bill of supply. So this also was issued as a clarification in 2017 itself. Somewhere in September or August, there was a confusion, and I think we have given that particular information from the department, and we will be taking that into picture. Then invoice for supply of goods issued on or before removal or delivery of goods. So if I am in a business of trading, so then once the goods are removed, 100% it has to go with a tax invoice only. If not, it has to be only if it is for sale or approval or return basis, then it can go by a DC. Or if it is going for job work, or if it is going for line sales. So these are ways in which they are other than the regular scenario. Only in these cases it has to go based on a other document which is there. It could be a line sales. So these where what the goods will go, but we have to see that the goods have to return back within a particular prescribed form of time. If it is not returned back, then the liability will be from the date of removal. So it is not only an important point to note that I have to pay tax on it, I should also look at if the goods are not received, then I have to pay tax on that particular from the date on which the goods were removed. Okay. Then revised invoice in case of new registration. See, in case of new registration, they have given a window of 30 days. If I have applied on 1st of May, I have applied for a GST registration, but I got the GST registration only on 20th of May. I have got the registration on 20th of May. There is a 30-day window where whatever invoices I have issued from 1st May to 20th May, I will be allowed to issue a revised invoice with GST. So this is an option which most of us, I don't know, many of us know or don't know. So this could be one more aspect which has to be looked into. For old invoices, I have to issue and I have to see that the tax has been remitted in this regard. Then receipt vouchers for receipt of advance. If I have received any advance, then we have to maintain a advance register along with a receipt book where we mention what is the amount we have received as an advance and what is the rate of tax we are going to pay. If the rate itself is not prescribed or we don't know under what amount it is going to go, we have to pay the tax at the rate of 18% IGST, okay, for all advances, if we don't know the rate. But generally most of us, we will be knowing the rate, but if we don't know what is the activity or what for this amount has come, then we will have to look at and pay 18% IGST. The next one is refund voucher for refund of advance received. Okay, so if I am refunding some advance I have taken for some, so some situation came and I had to refund back the advance to my customer, then I can issue a refund voucher in this regard and I can even give back the GST amount as well. But we have to mention that as a breakup in the refund voucher. Okay. Then payment voucher for RCM. So this I have already discussed that payment vouchers have to be prepared, and this can be we can make a once in a month one single payment voucher can be done and it can be kept. If it is digitally stored, then it has to be signed by a digital signature, any documentation. Otherwise, we have to take a hard copy of printout on a monthly basis. So we have to take a printout of the payment vouchers on a monthly basis, sign it and keep it. That is what the rules talk about for self-invoices or any documentation. Then next, document verification, debit and credit notes. So here we are going to discuss about debit and credit notes. So debit and credit notes, here as Madhur also was mentioning that this is a Herculean topic as such, but there was a circular which discussed about debit and credit notes. This came somewhere in last year, April 2018, where it was issued and they have clarified the procedures and process at which the debit and credit notes can be utilized, when it can be utilized, whether it is a means at the time of entering into the contract itself I should have known what is the discount I am going to get. If I knew that I am going to get a turnover discount of 1% at the time of me entering into the contract, then that I will be allowed to reduce it in my transaction and the company can issue a credit note for this particular transaction. And this one we will have to examine that initially credit notes and debit notes, there had to be a one-to-one correlation, one invoice, one credit note. But from 1st of February, the rule has got amended, the section has got amended. Now you can have multiple credit notes for a single invoice, or a single invoice, vice versa, multiple invoices and a single credit note can be issued. But the only thing is the portal is still not yet set right for this particular transaction or a aspect which has to be considered. So this has to be kept in mind, but that is only for 18-19 onwards. So for the during 17-18, you had to have for each credit note you should have a invoice number. That was the aspect. So that was one aspect which should be verified. Then e-way bill, if it has to be raised for all applicable supplies. So this has to be verified, as we need to do a test verification and find out whether all the e-way bills are going on track. So you can identify how many sales have happened, how many e-way bills have got generated. Automatically you will come to know whether these e-way bills are generated for all the sales or job work or whenever the goods have gone out and come back, except for if the value of the transaction is less than 50,000 rupees, there is no e-way bill which is required. So for this we will have to compare it with the e-way bill register. Then document series. So I think morning also somebody asked a question whether document series, if I have not done. So that is a rectification, but generally what should happen is whatever serial number you have given in GSTR 1 should match with my GSTR 9 or 9C, whatever serial number I am giving. So those have to match. So this is one thing which has to be kept in mind. Then outward supply, we will have certain checks here. So we have to look at classification. Classification is one of the most important aspects in our GST audit, because this is the first time we are doing a audit for the GST regime per se, and we have to examine whether the classification adopted by the assessee or the auditee is correct or not. If there is a mismatch, then I think we have to bring it to the notice of the department by way of a note. And there could be differences of opinion between the assessee as well as the auditor as well. So in those cases it is better to put a note to safeguard our interest as well as because, or you will have to tell the assessee to take an opinion, they can take a statutory opinion, so legal binding is going to be there. So he relied upon this particular judgment or this particular case law, and because of which or this particular understanding of the law, and that is how he came to a conclusion. So that could be put across. So as a note. And there could always be a classification issue, whether it is an interstate or intrastate. These are certain issues which are there. So for reasons, it could be the place of supply. If for example, a customer is coming from Hosur and he is buying some product in Avenue Road. He is going to Avenue Road, he is buying some product, he pays 10,000 rupees, he gets a bill, and the person charges CGST plus SGST. So because the goods got delivered here only. He is a B2C customer, so I think it is fine if we charge C plus S, correct? But if the same person, he tells I want a bill, give it in my name of my entity, which is there in Hosur, because it is used for that particular transaction. So the end result also has to be considered, because it's a B2B transaction. Even though the person is coming and taking the goods, still it is an IGST transaction. So their place of supply could change. So in those transactions, IGST has to be charged. So what has happened in the initial days, few of the claims or the auditees have got a confusion of this particular thing, whether it was a C plus S, I, all these things. Then only when the other person did not get a credit, they identified there was a problem, then they got this transactions. And place of supply also, we had to mention the place of supply. Many of the claims have not mentioned the place of supply, so that they issued again a clarification in the last couple of months on this aspect as to IGA, in case of place of supply, has to be clearly mentioned in the invoices, else there could be a liability on few things. So these aspects. Then zero rated supply. So what is a zero rated supply? Yes?
That's leftover. As of now, there is no tax, but in future, the tax may apply further.
Zero rated supply are nothing but exports. Exports are rated and SEZ supplies. So these both will be considered as zero rated supplies. So supply to an SEZ, there has been certain change in the law. So in that, if it is against an LUT, then it's going to be a zero rated supply, or if it is an export without an LUT, we have to charge these taxes what is applicable for the transaction. So that is where you will have to understand whether the basic provisions, basic procedures have been satisfied for an export, for a SEZ transaction, whether these have been properly done or not. So this could be another aspect which has to be looked into. Then we also have to look in whether it's a composite supply or a mixed supply. So every transaction has to be identified whether it's a composite supply or a mixed supply. So I think the law here has to still take shape with respect to the composition and mixed supply, because same transaction as per the department could look like a mixed supply. So for this, the PO, the documentation along with the invoice also plays a very vital role. To understand this with a small example, I want an AC. He tells the AC is 30,000, installation is 1,000 rupees. So he charges me total 31,000. So that is one situation. Second situation, he tells the supplier tells me I'll do installation free of cost, I'll charge you only 30,000. The third one is the AC is not on this side of the wall, I want it on this side of the wall. If this has to be done, we have to do a ducting. So he comes, he drills a hole, he makes a false ceiling and he brings this particular thing, and for that the AC is 30,000 rupees, installation is 50,000 rupees. So totally it is 80,000 rupees. So this 80,000 rupees, whether 80,000, what is the rate of tax applicable? So in 30,000 when we told installation is free, we are clear. The rate of tax was 28%, so I paid 28%. In the case of the next one, which is AC is 30,000 and the installation charges of 1,000 rupees was charged. So here, if installation is an optional transaction and if it is an optional transaction, then installation I get the AC. If I want, I will get it fixed by that particular person, or I can get it done by anybody. So in that case, installation is a service and that will be charged at 18%. It is not at 28%. So, but here there could be a confusion if it is not properly documented. If the invoice, if it is not properly done, if the wordings have not been used properly in the purchase order, then these things could become an issue at a later point of time. So here the third option, the AC was 30,000 rupees, but installation was 50,000 rupees. So in 50,000 rupees, should I consider that as AC rate or installation at 28%? 18% or 28% here? Huh? 28. Why are you telling it is 28?
AC is a big component, sir.
AC is 28%, that I agree. But for the installation, should it be considered as a composite supply and should we charge 28%, or should it be considered at the rate of installation is a separate works contract and that is a separate transaction, it is a separate service altogether, and what is the rate should be applicable. See, I may buy AC from somebody else, I can get the installation done from somebody else. So this does not become a composite supply according to my view based on the initial facts. But again we have to look at the purchase order, the contract, what has been entered into, because those play a very vital role and the language used also plays a very vital role. If both are in sync and they tell one is a single contract, then it could be called as a composite supply, or it could be considered as a mixed supply if it is a reverse transaction. In few cases, the product is at 18%, the service rate could be 28%. There could be a reverse of it. So in those cases, what happens? There could be a higher rate. The department will tell this is a mixed supply and they will tell you pay tax at the higher rate. So this is where we have to be very clear, and this is one of the opportunity for us to go through the transactions and identify where the assessee is and how the assessee is. So we also understand where the litigations could be possible and we can keep abreast of the assessee and keep him ready. These are the aspects, there could be certain issues. Sale of capital goods. Many of us
In the specified case for 50,000 is 18 or 50?
sir?
In this specific case of 50,000.
In general, it has to be at the rate of 18% only because it's a separate contract altogether. But again, as I told you, the contract also, the PO, the contract or an agreement, if it is entered into, that plays a vital role. Whether it's a single contract or a multiple contract. So it is always better to have two contracts to avoid litigations or from the department. So we have a separate agreement for supply of AC and separate agreement for installation. So this will have avoidance of confusions and complications. Sale of capital goods. See, I have an AC. We'll take an AC because we are discussing about AC. So I want to discard an AC. When I want a new AC, old AC is discarded. So when I am discarding the old AC, should I pay tax? Yes or no? Yes or no? Why no? Why yes? AC, isn't it a commodity? It is depreciated. So it has become zero rate in your books of accounts. So I will not pay. Can I tell that? So any transaction when we are selling the product, whether as a second hand or as a scrap, whatever rate applicable for the product has to be discharged. And this, when we look at the balance sheet, we will come to know that there is something which is left out. And when we look at the balance sheet, when there is a reduction, and there is a reduction in the value other than depreciation, you will know that some item has got sold. And in this particular transaction, you will come to know where we are and whether tax has to be discharged. So it will be better for us to discharge the tax once these transactions are come into picture. But few things, capital goods, you have to look into. Say it's a vehicle. So for vehicle, there is a separate notification which told that you will have to go through the depreciated value, and whatever is the depreciated value, if it is a pre-GST purchase, then you have to go to the pre-GST purchase, what is the depreciated value and what is the transaction value. Because I was not eligible to take credit under the VAT regime as a vehicle. It was a Schedule 3 item, I was not allowed to take. So vehicle I bought a car for my office. Now I am selling the car. So the depreciated value of the car as on the date of sale is 1,50,000. I have sold it for say 1 lakh. So in that case, no tax need to be paid. So we have to look at, see, it is not that everything, there are so many aspects for each thing. We will have to look at these aspects and we have to understand the logic behind, and we will have to take these forward into the form. So that is what is more important. If I sold it for 2 lakhs, then I have to pay tax on 50,000 rupees. I need to have discharge. So you could have, that has to be done. And it could be a capital goods, it could be excisable goods. I bought a machinery. Earlier I had taken SENVAT credit and I have also taken VAT input credit. Now I am selling that machinery now. So that machinery is removed from my books of accounts and not paid taxes. So do I need to pay taxes? What is the rate I need to pay taxes? That is important. So I bought a machinery for 10 lakhs. Today the depreciated value is say 2 lakhs. But I am selling it today at 3 lakh rupees. I sold it at 3 lakh rupees. So on 3 lakh rupees I am supposed to pay the taxes, provided I need to take the depreciated value for under the law which tells there is a depreciation or diminution to the extent of 5% in case of capital goods, 5% per quarter in the case of capital goods. So 20% is the depreciated value. So if I bought it 2 years ago and I have sold it, then I will get a depreciation only to the extent of 40%. Say 2 years has elapsed, it is 8 quarters into 5, which is 40%. I will have to reduce it by 40%, and if that value is more than the transaction value, if that value comes to 5 lakhs, what I have sold is 3 lakhs, then I should discharge tax on 5 lakhs and not on 3 lakhs. So this also has to be kept in mind. So these are aspects which you need to look at more than the calculation portion. So these are aspects which are outside the balance sheet. It will not be seen in the balance sheet when we look at it as it is, but we will have to look at a little in depth into these aspects. Deemed supply. So we also know that deemed supply is within our own entity. There could be a sister concern, principal agent. So when a transaction I sold it to my agent, even though there is no, technically there was no tax under the VAT regime on these transactions, but under the GST, now if I am sending the goods to my agent, if I am sending 10 crore worth of goods to my agent, on 10 crores I have to discharge the tax as soon as the goods are removed as a principal, and the agent will be able to get a credit of it. So these aspects are deemed supply, and we will have to look into these aspects also. Then goods sent to job worker. So if the goods are sent to job worker, so if it is an input, then it has to be sent. What has been sent has to come back within a period of 1 year. If it is a capital goods, it has to come back within 3 years. Okay. So this is being the first year of GST audit. 17-18 is the first year of GST audit. You may not have an issue because 1 year is the time frame. So still you had 3 more months. But if you look at the post-mortem, because now we are doing a post-mortem work, so already that 1 year time is also elapsed. So kindly verify what is the impact, whether the goods have got returned or not. We will have to examine. And if the capital goods has to come within to our factory back. The capital goods, it could be other than jigs and fixtures, which they are told need not be got back. What are jigs and fixtures? It could be some small tools or small things which have been sent, and it is very difficult for me to get back those tools. It may break. See, there could be a drilling bit. The drilling bit is sent. I as a supplier, I sent drilling bit also. So these drilling bits wear out after a period of time. One drilling bit could come for him for a month or 2 months. Then he has to discard that. So they don't want to have that particular thing. So they are told that they have exempted from the receipt as such, because that would have got consumed during the course of production. Then rate of tax for supply, which I have already discussed. Rate of tax. Rate of tax for supply here means whatever the product cost is there, which I have sent, and if it does not come back, then I have to pay the tax on the product what I have sent. On that, what is the rate applicable which has to be paid? That becomes the responsibility of the manufacturer or principal manufacturer who sends the goods to the job worker. And there are certain conditions that I should register the job worker's premises if the goods have to be removed from the job worker's premises as such. Then that premises could become an additional place of business also. Okay. Then if there is any rating change, then I think classification I already discussed. HSN I think we have already discussed this also. Then valuation of supply. So this is one of the thing where what could be the value of supply. So this has to be looked into in case to case basis, and we'll have to understand whether pure agency is available, not available. See, as a chartered accountant, if I am providing a service, I am providing a audit opinion, and I tell my charges are 1 lakh rupees. But there is a reimbursement of expenses. Okay, there is a reimbursement of expenses. I claim the reimbursements. I go, if it is an outstation, there could be a travel, there could be flight charges, there could be a rail ticket, there could be food, all these things put together, that is coming to 50,000 rupees. So, what is the value on which I have to pay taxes or collect it from the customer? Is it on 1 lakh or 1,50,000? I am claiming my actual bills only. I have got the Xerox copy of all the bills, whether I should claim on 1 lakh or 1,50,000. I raise a credit note, or I raise a debit note, and I raise the bill. So here what happens, pure agency, whatever the amount what I pay has to be added, because the bills are not in my name. Or if the bills are directly in the name of the customer, for example hotel raises the bill directly on my customer's name, but I just make a payment and I am getting the payment, then that is a pure agency contract. If it is a pure agent concept, then I need not pay taxes. But if all the conditions of pure agent are not satisfied, then I have to add it to my whatever. The reimbursements also become the part of my composite supply, and whatever is the principal supply, whatever is audit fee or opinion work, whatever we do for 1 lakh, that is the rate which should be applicable even for these particular transactions per se. Okay. Then discounts, I think this I already told. Discounts, if it is anything which is agreed at the time of the transaction, entering into the transaction, then or based on the agreement, that will be treated as a discount. And for post later on, first I have sold all iPhones. iPhone 10 in October I sold, but today the new model has come, so the old model lost its thing, so there was a minimum support which the company told, I will give you 20,000 rupees per phone as a discount. This was not known at the time of sale, but it was a post discount. So for these transactions, so they have told in that particular clarification, if it is a post discount, then it only a financial credit note and not a credit note with GST I can't give on these transactions. So this is what has to be kept in mind. Then pure agent I discussed. So this one rate exchange also I told you already in the course of discussion. And any wrong payment of taxes. If I have by mistake paid, instead of paying CGST I paid IGST, then if it is not, I cannot set it off against the future liabilities, then I can go for a refund. Like one of the case in our office, the client has by mistake, instead of paying amount as IGST, he paid it as a cess. So cess I will never use it, because my business I don't have cess itself. By mistake I paid it cess, then in those cases I can apply for a refund in the applicable form filed. So RFD 1 or 1A, whatever form is applicable, I will file and I will have to get for a refund. But I have to prove to the department. The department is going to ask me 101 questions, so that we have to answer and we have to get the refund. So then we have input side. Input side we are going to look at now. So if I have to claim my input tax credit, I have to claim. So in that case, for input tax credit, I will be able to claim the input tax. Okay. So for that there are certain conditions. What is the few conditions? There are a number of conditions under section 16, but there are later on they told 4 major ones. You need to be in possession of a tax invoice. You should have received the goods, and all the contents of the invoice have to be clearly mentioned. That is a GST number, and it has to be reflected in the 2A. So these are certain conditions which have to be satisfied for me to availing the credit, and I should have made the payment to the supplier within 180 days. This is one of the important criteria which has to be complied with. If I don't make the payment to the supplier within 180 days, then I will not be able to get the credit. So what happens if the customer, the debtor only has given me a interest-free period of 1 year. So he has told I will make a payment after 1 year. So then in that case, it is nothing but a financial arrangement where he has given an interest-free loan. So it is as good as we have paid the amount to them and the amount has become an interest-free loan, and pass an entry in the books of accounts from your creditor account to a loan account. So that is what you will have to pass, so that on a later date, so this becomes a proof, and this you send it to the customer, and it is better that is documented also properly. So this, because the department could question why your payment is not made but you have availed the input credit. But documentation wise, because there is a purchase order where there is a clear understanding that I can avail that 1 year time frame. So, or it could be a 2 year time frame. Many of the creditors give this particular option, but only thing, if it is an import transaction, then RBI guidelines have to be followed. So for that you will have to, whatever the RBI tells, within 180 days or 1 year we should get the payments, else we should inform the RBI about this particular transaction that we have asked for further time of extension, and if that RBI authorized signatory allows you that, then in that case you can further take it forward. Then whatever for reversal, if there is any reversals which have to be done, it can be done from your credit ledger. But if there is an interest payable, interest cannot be set off against your credit. So interest has to be paid in cash only. And for GSTR 9, there is a difference of opinion. Few of them are telling that we can utilize the credit for payment if we have a credit balance. But here there is a little bit of a grey area where few of them are telling yes, we can utilize the credit. But as per the department, you have to pay based on the DRC03 only, it has to be paid. But in DRC03 you have an option for cash and credit both in that particular form per se. Then we also have to look into 17.5 ineligibility. So what are the ineligible transactions where you are not supposed to take credit, or the block credit transaction under 17 has to be looked into, and this has to be read with 42 and 43, where if it is input and input services it is 42, and if it is capital goods it is 43, rule 43. So these both sections, section and rule have to be read together, and it has to be, there's a small error here, okay, 42, 43, it's a rule. Okay, then capital credit on capital goods. See, if you have both exempted as well as taxable transaction, then capital goods credit full is not eligible. So on a monthly basis we have to reverse the exempted portion of capital goods. To understand this, I have a milling machine. This milling machine, I buy paddy and convert that to rice. In that rice, I make two rice. One is unbranded rice, one is branded rice. If it is a branded rice, it is at the tax at the rate of 5%. If it is an unbranded rice, it is at the rate of nil rate of tax. So assume that I have bought a milling machine worth 1 crore. The duty paid on that particular is 18%, which comes to 18 lakh rupees. I have taken capital goods credit of 18 lakh rupees. But I have made a turnover. I have made 1 crore sales of paddy, that is unbranded rice, 1 crore sales of branded rice. Then in that particular case, in 50-50 ratio, I should reverse the credit here.
As per the turnover ratio.
As per the turnover ratio, as per the formula is being given, and this credit has to be set off over a period of 60 months. So we will have to go to rule 43. Based on rule 43, this particular transaction has to be looked into. Okay, and this reversal has to be done on a monthly basis, and this can be done again at the yearly. See, 42, 43, you have to do it. One is monthly you will be doing, and based on the actual transactions, you will have to do that on a yearly basis by 30th June. So you will have to follow this particular methodology, and you will arrive at the actual value. If the input tax reversed is, for example, you have reversed 10 lakhs, but you are eligible for 9 lakhs. So that 1 lakh, whatever additionally you have reversed, you can take that recredit. If they reverse, then you have to pay 1 lakh, and this has to be done before 30th of June. So this has to be done for the current year work. What I am telling for 18-19, this has to be done, and 30th June will be the last date for doing this activity. Then books of accounts versus returns claim. What happens if I have not claimed the credit in my books of accounts itself, but I am claiming it in my returns? So in this particular case, you can pass an audit adjustment entry in the books to set these errors which have already taken place, and you can take the entire credit. For example, during 17-18, I have not shown that particular credit itself in my books of accounts. So in the books of accounts, the next year you are going to pass on audit JV and show the input tax credit in the books of accounts, and that has to be matched with the financials. But what is a reverse of it? I have it in my books of accounts, but if I have not declared it in my 3B, then in that particular case, I will not be able to take the credit, because the time for taking credit or availing the credit up to 31st March 2019 is already done away with, and I cannot do anything now to that extent. Then there are few more inverse apply checks which are there. So here with respect to restaurant category, I told you there was a change in the rate of tax. So all restaurants have to go based on 5% category only without input tax credit. There is no availment of input tax credit. So in these cases, so there was a stock. What was the stock as on the date of this 15th of November? I should have reversed that. So have I done that? Is one aspect which has to be examined. And if I am following a different methodology, paying 18%, there we had two options. So that 18%, if there was an outdoor catering, then I am still allowed to take the input tax credit what was availed. I was, say if I am under composition scheme first and then I move to the regular scheme, then I will be allowed to take the additional credits. So that is one thing, how the assessees done this particular aspect, that can be examined. Then there was an amendment with respect to section 17(5), which was under the CGST Act 2018, but it got approved with effect from 1st of February 2019. So these things are allowed, or those are few changes, but that will be only for 18-19 onwards, but not for 17-18, because 17-18 the law was the old law only and not the new law, because people tend to get confused. So don't get into the new law, go to the old law, look at the old provision, because many times we take the new book and start reading, so we may get confused, so don't do that. Then if there are any reversal due to impairment of assets, if say something has become obsolete, I write off in my books of accounts, then those transactions, if it is written off permanently, then I have to reverse the GST, proportionate input tax credit, what I have availed, I have to write it off in the books of accounts. RCM on ocean freight, if I have bought a machinery or my supplies from outside the country, and RCM, if there is an ocean freight which is there, so on that, as per the law, if you see on ocean freight, we have to pay tax on reverse charge basis, but there is a amount of difference of opinion, because on the transaction I would have already paid at the customs authority. Customs authority would have taken the total value plus the insurance plus freight. Based on the total only, they would have already collected taxes. So this was an issue under the service tax law. Later on the law itself got amended. They told that there is no requirement of payment of taxes on this ocean freight. But if we are eligible to take these credits, then let us comply with the law. If it is not possible, then we will have to be ready with the litigative front on that particular transaction. Let us look at the quantum of transaction. If the quantum of transaction, we might have to see, if it is only say 10,000 rupees, it's not worth the litigation. But if the same thing is more, if the quantum is say 2 lakhs or 5 lakhs, then it is worth the litigation to that extent. Then goods destroyed. Any goods destroyed, then we will have to reverse the input tax credits to the extent of goods destroyed. Okay, under 17(5). So 2A reflects higher credits versus books. So if 2A reflects a higher credit, I am not eligible to take it, because in the books we are not accounted for. As I told you, we will have to cross a adjustment entry, and in the books if it is set right, then it should be a no issue problem on that factor. Okay. So other issues, interest, this interest whatever we have to calculate is on the gross liability. That is what at present the law is. It tells you all have to pay the tax on the gross liability. But there was a GST Council proposal in the last year when this Amendment Act 2018 came. Before the Amendment Act, GST Council recommended that the aspect, say if I have a liability of 10 lakhs and there is an input tax credit of 9 lakhs, so the interest has to be calculated only on 1 lakh. That is what is our understanding, and we have paid on this 1 lakh. But here there are few advanced rulings which recently also they have told it has to be on the gross value. So this is where there could be a difference of opinion, and we have to probably, if the client is not ready to pay the taxes on the gross liability, then a note has to be affixed on this particular transaction. And books of accounts have to be maintained at each place of business. See, if there is a factory or a godown separately, then in the godown separately a stock register has to be maintained. What is the stock available on hand, how much got received, how much got sold, or how much got stock transferred, what is the net value has to be looked at. A stock register has to be maintained with respect to this transaction. Then interest, as of now, if you are ready to calculate and pay the interest, let us do it rightly now. So maintenance of inward and outward register, maintenance of input tax register, maintenance of stock register, and valuation, verification of ITC 04. ITC 04 is if I am sending goods for job work, then the job worker as well as the manufacturer both have to file this returns of ITC 04. Then reconciliation. I'll just run through this. I think Madhur has already covered this in detail. I'll just tell you one simple formula here. Only thing is, take the details as per our books. He told 5A in that 1 plus 1 minus 1 plus 1 minus, all those things you do. I will not get into each item. In each item anyway form is there, you can go through the form. What has to be added in that particular form. At last you will get one figure. That figure you will have to show what you have already disclosed in GSTR 9. That is 1 point. And the balance becomes a difference. Why you did not show in your GSTR 9, you will have to put that supporting information. Generally it has to be 0. Otherwise you will have to give an explanation why this particular transaction is supposed to be given or not given is one aspect which has to be looked into. It is clear? So this is a small thing where only 1 point. You keep in mind that this is how the thing happens. And most of these figures of details in annexure, whatever is given in annual return, figure is coming automatically. It comes automatically from the system. So because you would have already filed GSTR 9, those figures will automatically get populated and you can see those figures already sitting there. If you want to change, you can go and change those figures. And for every reconciliation, every P&L account item has to be taken and it has to be reconciled with each and everything. It could be income, it could be expenses. If it is an income, then you will have to take all the GST paid. It could be taxable items, it could be exempted supplies, it could be non-taxable supplies. Take each and every item from the P&L account and break it up into these transactions, and that has to match with my GSTR 9 basically. So if there is a difference, if the assessee has filed a 9 and if there is a difference, we will have to identify why the difference is there. That is what this entire reconciliation is about. Okay. And I have just got a few formats here. So these formats, anyway this PPT will either be put across the web or it will be circulated. So you can go through this in detail. So for everything we have got a table. So this table, if you try to put the information in this table, we first have a rough information, and this information you can fill it up into the GSTR 9 or 9C. So you will have to take this information, take the figures as per P&L account, arrive at the figures as per the GSTR. If you go to the last as per GSTR 1 or 3B, it has to match. So we will have to take what is the total figure as per P&L account, keep on doing a plus and minus for this particular thing. You will have to arrive at this transaction GSTR 1. So the first case will always be difficult, but once we are through, we know where we are going wrong or what is the information, then other cases are surely going to become simpler. It is not that every case is going to have all the options. One case may have only renting. If you have only renting, you have only one income. Why are you worried about export? Why are you worried about SEZ? It's not required. We are going to look at only that aspect and we are going to fill up the form. So initially what you can do in your offices, take only which is simple. Take one simple case, put all the information in that particular format and you can prepare the form accordingly. And now you also have online forms, and I think the speaker of the next session will surely share you the Excel formats which are there already, and it will be easier. And I will also show you the online download of 9C, and it is in Excel format and it is easy. So only thing is it has to be validated. Every table has to be validated with this GSTR 9 which I told you. This one. So 9 figure has to match with the thing. So that they are cross verified. If it is matching, then there is no issue. So your validation is done. So I will not get into much of reconciliation here again. So what are the prerequisites for GSTR 9? So 9C. One is you need to have a balance sheet. That is a statutory auditor, whatever he has done, we are going to attach the same balance sheet for each of the units. Say in Karnataka we have one registration, we are going to upload balance sheet, then we are going to upload profit and loss account and income tax, income and expenditure account has to be uploaded. So, but if there are more than one entities, say there is one branch in Karnataka, one branch in Tamil Nadu, so we have two registrations. So both the registration data has to match with your total transaction. So this becomes difficult. That is what Madhur was telling. In few cases, because of the problem of the software, we may not be able to get all the information as it is like a trial balance. If this branch is maintaining a separate tally, that branch is maintaining separate tally, it becomes easier. So this also has a separate trial balance, that also has a separate trial balance. But most of the softwares, few of the softwares don't have that one. So they all get into a club account. So everything is mixed and it's a chow-chow. So we are not able to take all the information. So in those transactions, what we have to do is we have to take each of the ledgers, what is required, put it into one. So take it into each of these particular transactions, put that into one bucket. Then you prepare a separate trading account for Karnataka. We might have to do that. Separate trading account or separate income and expenditure for Karnataka, separate income and expenditure for Tamil Nadu has to be prepared, and that has to be attached here for our computation. But they have never told that these things have to be given. So other one is the trial balance of each branch in other state. So this could be an added advantage to that particular transaction. Here, next. What is the technology which is required? One is OS 7. So Windows 7. So these are all basic requirements. Anyway, I am just telling these are required because many a times we are ready to upload. But if a few things are not working, if some Java update is not working, we can't file. Or if some version of Java is not there, it will not file. So you can go to the GST portal. I think Karnataka has a very good GST portal. Updates on all these things are already there. So, and our help desk people are here only. So you have anything, you can ask them directly. So in the lunch break. Okay. So you can look at these things, what is required, and you should have the required. You should have the required requirement. If it is not there, I can't work. If you want to see a movie in your mobile, you know what has to be downloaded, no? You know or you don't know? You know. So similarly here also for GSTR 9 and 9C, if you have to upload, you should know what is the required requirements which is required for the system. So it is like if you want to run a vehicle, you have to put petrol or diesel. If there is no petrol or diesel, vehicle will not go forward. So this is one of the ingredients you have to put it. Simple. Okay, for that you want MS Office 2007 and above, Excel utility to be operated along with. So you should know Excel utility which is required. Then WS Web, this is a web-based application required for generation of JSON with DSC. So these are all few things which are required. Next, validation. As I told you, you need to validate these files. And based on this validation, step-by-step process is required. Once this validation is complete, I think it is not difficult because we have been doing a lot of 1 and 3B. This is also one of the simpler ones which is there. And for every column in GSTR 9C, you will have a residuary clause like 5O, which Madhur showed you. 5O is a residuary clause for para 5. So you have to fill all the other columns and the balance should be 5O. But it is not that you just put everything in 5O. That should not be the way, because you have to have a working system, why you did it or what you did, what were the clarifications. Because today you will remember everything. Tomorrow, 100% you all will become budding chartered accountants, you will leave the office and go. So somebody else will come. So on that day we would have got some scrutiny notice. We don't know what for or what has happened. Then again we have to do an R&D. Because we will have, for every file we will have version 1, version 2, or we will put name. So we will put Shaker 1, Shaker 2, Shaker 3 and Shaker Final. Shaker Final 1, Shaker Final 2, Final 3. So like Inter, IPCC, Final, we will have everything here. Okay. So let us avoid these things. Let us have final documentation which is very important for us and see that it is uploaded to the services of each of the files. See, there are certain issues which are there with respect to this one. I think here it will be a little of a repetition. I will just take up only what is required here. So I think cross-charge versus input service distributor. So I think in the morning as well, Madhur spoke about that particular Columbia Asia case where it's a Karnataka judgment, advance ruling where it was there, where they told that if there is a common charge which is there, which is allocated, so those are a taxable transaction. That is what it told. So, are you having a separate input service distributor registration, or are you doing a cross charge? Only these two has to be examined. So, what has happened in the earlier days? Look at that and see if there is a cross charge. For example, in Columbia, Asia, what happened? Bangalore is the head office. They have different units across separate places. Say, for example, we'll just take two for understanding. One is in Bangalore, one is in Hyderabad. They have two offices if we consider. So, if their Bangalore is using a major software, so that software cost is allocated to Hyderabad. There is a employee cost. So, employee cost is, because if a person is sitting, he is doing for Bangalore also and he is doing for Hyderabad also. Maybe the same person is doing for invoicing for Bangalore and invoicing for Hyderabad. So, in those cases, common admin charges which is there, it gets allocated to each of the branch. So, one is for Bangalore, what is the actual value, and another one is for Hyderabad. So, if in a month I identify 10 lakhs as the cross charge amount, then I have to bill that amount to Hyderabad. So, that is what the decision told. Clear? So, you have to see that aspect. But again, there is a different view why it is not applicable and all. So, wherever it is possible, let us be more conservative so that future there is no issues with the department. Then what happens is, many a times our knowledge itself improves. See, earlier when I was doing my classes, my thought process was different. Today, if you maybe look at, or somebody who has heard my lecture a few days back, based on few, at that point of time, what was my knowledge, I would have given my opinion based on that knowledge. Now, after so many advanced rulings, for, against, we have so many things, then my knowledge is different today. So, if you ask me today, I will tell on today's perspective and not on that day's perspective, and that is where further problems could erupt, or these are transactions which have to be looked into. What happens if goods are in transit? As on 31st of March, my supplier sent goods. He sent the goods from Calcutta. It was dispatched on 30th of March. But it reached my office only on 1st of April. From Calcutta, it had to reach me. So, I am in Bangalore. The goods came and reached me only on 1st of April. So, when can I take the credit? March. Because the supplier has uploaded, it is already reflecting. I can, based on the invoice, I can take credit. Right? Yes or no? How you can take? See, for goods, the condition under input tax credit rules or the provisions tell that unless and until you receive the last shipment for that invoice, not even if you have received proportion, I can't take. Only after the last shipment is received, I can take the credit of that amount. So, the goods reached your office only on 1st of April. You can't take it on 31st of March. You have to take it on for the month of April only. So, these are aspects which have to be considered and we will have to look at it. Then, when we are reversing 42 and 43, if I have interest income, it's a financial transaction, it is an exempted income, but for my 42 reversal, interest need not be considered in the formula. That is what, there was a clarification and there was a clear-cut understanding. So here, this one tells that I need not take this 42-43 for the interest, I need not consider this aspect. That is what they told. Okay. Then with respect to the reversals, but if it is a common, for example, I have a petrol bunk. In a petrol bunk, you also deal in, one is you deal in HSD and petrol, which is an exempted or a non-taxable transaction, and the other one is, I also deal in lubricants, which is oils, which is taxable under GST. So I will collect GST and remit this GST. So I have a turnover of petrol bunk, if you see, I have a turnover of 10 crores, but lubricants I have a sales of 1 crore. So I have to take the input tax credit, say it could be audit fee, it could be security charges, manpower supply, any of these transactions where there is a common credit, then those I have to reverse based on 42, and there we have to calculate this. So this is what has to be examined as to what was adopted earlier and what is adopted now. And also it has to be, as I told you, this transaction of 42-43 has to be done for July 1st to March 31st of 17-18. It should have been filed before 30th of June 2018. Clear? So that also has to be cross-verified whether they have taken a proper credit or not. That has to be examined now. And value of tools and dies, I already discussed about this particular transaction. So I think this is the last 1 or 2 slides. We'll just close in a couple of minutes, about 5 minutes you can just wait. So one is audit focus. We have to mainly look at the classification which I told you, classification old rates and what is the new rates. Under excise what I had adopted, or earlier VAT regime what I had adopted, and now under the GST what is the rate I am adopting, because what was the classification I used earlier and is there any change in the classification. Few of the products got changed. So there could be a genuine change in the classification as well, but you have to have a track record. That also should be examined. Then input tax credit in detail we have looked into. One is ineligibility, that is under block credit under 17.5, or credit reversals for capital goods and others where you have exempted or non-GST goods, which we discussed in detail. Then reconciliation between books of accounts and returns. I think that 9C is nothing but a reconciliation, or when you do 9 also you will come to know the reconciliation aspects per se. Valuations, generally when there is a deemed supply or schedule 1 items which are included, for example gifts to employees above 50,000. So there are a number of things which are there under schedule 1. So if the schedule 1 transactions get triggered, then section 15 gets triggered. So there we have to identify what is the value and that has to be looked into. And as we have lot of frequent changes, so I think we have to have a master index for every client. We have to make a master index where we are going to mention these are the GST notifications, these are the sections which are applicable for this particular assessee. This is the classification we have adopted. This is the nature of business of this particular company. So a master file has to be adopted so that this can be used for later also. So you can create a master file in this particular client. So there you can see. So then based on that you can take it forward. And the last but not the least, it is the auditor to take care of engagement letter with the auditing. We have to have a proper engagement letter. Otherwise, the starting I told you, no, 499 rupees. What did I show? A road roller. That is what is going to have become our plate. Department will start asking me 100 questions. The client will ask 100 questions. We will get sandwiched if we don't take care properly our fee structure also, because if you tell I will do the audit for 5,000 rupees and here there is a mountain standing here, then you will have to spend 45,000 rupees to see that you have safeguarded your client. So I think we need to consider the time involved and the quoting of fees also has to be done. Then representation. There are few things where we have to take for safety from the aspect, because it's the responsibility of the management, and few things we have to put in the representation letters what has to be done, and these letters are already available in the GST portal, ICI portal, where representation letters. In the background material already we have all these informations which are there in detail. Checklists are also available. See that you start making use of this checklist. At least if you don't take the big checklist, convert that into small one, where if they have covered some 400 points, you take what is applicable for this client, convert that into a small checklist and keep that checklist for your client. Otherwise what is going to happen, we are going to miss out on few things and it could become a damaging factor. Then recent updates in audit. So I think you all have got a lot of knowledge. I think by the end of the day you will have ocean of knowledge only. So probably we can swim in that knowledge today. Okay. Then proper staff with technical knowledge. I think this is what your people have taken built. So whoever are probably into the articleship zone, I think you will be helpful for your principles as such. Then continuous evaluation of knowledge. See, it is not only that we are supposed to read for the purpose of doing some work. No, it is that you people have to read for your upgradation. It is not for principle's sake you are doing. You have to read for your knowledge upgradation, because if somebody asks you something, and if you are in a chartered accountant's office or in a financial consultancy office, and if you are not able to answer a particular doubt which a client has got, or which somebody asked you a basic doubt and you are not able to answer, then it is not worth the person. So we should always read something more than what is required. Then we have to have a proper software for getting all the inputs and outputs, or we have to create one in Excel. So this something has to be done. discussion on various issues and conclusion thereof. So wherever we have issues in your audit team, discuss with your seniors, put those into record, why this was for, why this was against, and why you considered this for or why you considered this against, what was the conclusion. Make note and keep it, because as I told you, law is changing very fast, and if you ask some notification which has happened in 1st of July, I don't think I will also be able to remember. So this is what is happening today, so many changes are happening. And I think with this, I have concluded my session, and I have overshot by 20 minutes. So kindly excuse me for that. I have withheld you for your lunch which is there on the rooftop. I think I just hand it over to our MJ here.
Thanks a lot, sir, for throwing a bright light on the topic. I request Managing Committee member Swarnalata ma'am to honor sir with a token of gratitude. Thanks a lot, sir. It's now time for the lunch break. We have arranged the scrumptious lunch for you people in the canopy. You can have 45 minutes break. Be right back exactly by 2:45. You have 45 minutes break.